Today, we're taking a deep dive into Sanquan Food. Now, this is a titan in China's frozen food industry, but right now it's at a really critical juncture. We're going to break down the data to understand the pressures it's up against and what the future could hold. So what's really going on here? Our analysis shows that its recent struggles aren't just a temporary blip. They stem from 4 deep structural pressures, and these are the core themes we're going to unpack today. All right, first things first, let's quantify this pressure. Just how wide is the gap between Sanquan's performance and the overall market? Well, this number is incredibly telling. A negative alpha of over 8% means the stock didn't just lag the market. It actively declined while the benchmark index was actually climbing. That's a huge signal that the issues here are company-specific, not just a reflection of broad market trends. And this chart just illustrates that divergence perfectly. You can see this significant performance gap opening up in just a single month. This was really driven by a mix of weakening consumer sentiment and, frankly, just fierce competition. But you know, what's really fascinating is how the stock has been declining. This wasn't a sudden panic, not a mass exodus with huge trading volume. It's much more like a slow leak. The price just gradually drifts down as interest dries up. And that tells us something important. Investors aren't necessarily scared, they just seem uncertain about where the next catalyst for growth is going to come from. Okay, so that's the market picture. Now let's move on to the company's strategy, because Sanquan is fighting a very difficult two-front battle. On one side, you have its traditional retail business, which is just bogged down in these brutal price wars that are crushing margins. Then, on the other side, its strategic pivot to supplying restaurants, which was supposed to be the growth engine, is actually sputtering, with revenue falling. It's a classic pincer movement, and it's squeezing profitability from both directions. And on top of all that, you've got this major pressure point in its cost structure. Meat makes up roughly 40% of its raw material costs. So when global protein prices get volatile, like the rising beef prices we saw in the first half of the year, that hits the company's bottom line directly. There's very little buffer. So the crucial question is, how do all of these pressures translate to the bottom line? And what does it mean for the company's competitive standing? Okay, this DuPont analysis is like a financial X-ray, and it tells us a very clear story. You see the return on equity plummeting from over 22% down to just over 12%. But look closely. It's not because of its financial structure. The equity multiplier is stable. The root of the problem is operational. Both its profit margins and its asset turnover are getting weaker. They're becoming less efficient at their core business. And this slide in performance has directly impacted how the market perceives Sanquan's competitive advantage, which you might call its moat. And this table just brilliantly illustrates that erosion. Sanquan's valuation multiple, its PE ratio, is now almost identical to its main rival, Enjing Food. What the market is signaling here is that it no longer sees a premium for Sanquan's historical leadership. They're now viewed as peers with very similar risk-reward profiles. But now let's turn to the future, because there is one single massive potential catalyst on the horizon, a looming regulatory shift that could rewrite the rules for the entire industry. So what's happening is the government is developing a national standard for pre-made dishes. This is a direct response to public concern over food transparency, which was really highlighted by things like the recent Shibe restaurant controversy. And we see the implementation of this standard potentially unfolding in 3 stages. First, it's going to raise costs for everyone, new rules on things like preservatives and cold chain logistics. Second, that cost pressure will likely trigger a market consolidation, forcing smaller, less capitalized companies out. And that leads to the 3rd stage, a real opportunity for established leaders like Sanquan to leverage their scale and capture that market share. So, given this very complex landscape, what are the critical indicators that we should be monitoring to see where Sanquan is headed? Well, first, you have to watch the core operational numbers. Is that B2B restaurant segment recovering? Are profit margins finally stabilizing? And are new sales channels, like the partnership with Snack is Busy, actually starting to deliver? Second, you have to monitor the external environment. The timing and, more importantly, the stringency of these new regulations are paramount. And of course, you have to keep an eye on commodity prices and the competitive moves of its chief rival. And all of this brings us to the final crucial question. The data clearly shows a company under significant pressure, but one that is also positioned at a potential inflection point. Its future will be determined by its ability to execute a very difficult strategic pivot, all while navigating a fundamental reshaping of its entire industry.